It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
So Nuvei Corp is a provider of payment technology solutions to merchants and partners. The solutions provided are mobile payments, online payments, and in-store payments. The stock currently trades under the symbol NVEI at roughly 55.80 Canadian on the TSX, as well as $40.80 US on the NASDAQ, and it's roughly up 60% year to date, but it's still down 70% from the pandemic highs. So, the company just released its Q4 and fiscal 2022 results on March 7th, reporting an increase in transaction volume of 34% to $127.7 billion. Revenue has increased 16% to $843.3 million, but was unfavorably impacted by foreign exchange as it reports its earnings in US dollars, which strengthened significantly in 2022 compared to effectively every other currency. So on a constant currency basis, revenue increased by 22%, so a 6% or so drag occurred from foreign exchange. They are becoming less dependent on cryptocurrencies, with revenue from that segment only making up 8.7% of revenue for Q4, down from roughly 21.8% in 2021. Excluding the impact of FX and the cryptocurrency segment, revenue grew by actually 26%. So all those adjustments in their core business, 26%, and that's actually what they see going forward roughly. On the other hand, adjusted EBITDA increased 11% to $351 million due to high revenue and removing the core increased expense of share compensation, which I'll get onto down the line. And on the other hand, net income fell by 42%, and this is GAAP net income, I should note, to $62 million. Share compensation was the core reason for the decrease. On a diluted per share basis, still GAAP, it fell 45% to 39 cents per share from 71 cents per share. Additionally, the company reports adjusted net income, which increased 10% per share to $1.86 from $1.69, a significant difference from GAAP. It's because it removes the impact of acquisition-related expense, foreign exchange, and a couple other minor things, but most importantly, share-based compensation. These types of adjustments generally reflect the operations better than GAAP, but they reflect the earnings attributed to shareholders worse. That's the trade-off, and that's why you really want to look at both numbers. We've commented on this a few times before, but Nuvei is a perfect example where you shouldn't ignore the share compensation completely. They are actively buying back shares in excess of their share compensation. So effectively, they issue shares to employees in lieu of cash, and instead use that cash to buy back shares on the open market, ultimately making the same impact on the financials at the end of the day as normal salary would instead of share compensation. Management does claim that share compensation will stay relatively flat at these levels, so it would drop as a percentage of revenue as revenue goes up. This is something we will track going forward, and if you are an investor or prospective investor, it's something you should pay attention to as well. So, after the 2022 fiscal end, Nuvei finished its acquisition of Paya for $1.3 billion in cash, which has significantly altered its forward earnings and its balance sheet. Paya, just as a gauge its size, they processed roughly $50 billion in payments in 2022, roughly 39% of the amount Nuvei did, just to give you an idea of the size of the integration. It's not like it's a one-to-one, but it's still a significant amount. It's not a small transaction either. To fund the purchase, Nuvei entered into a $800 million credit facility. After the acquisition, the company is now in a net debt position of approximately $1.06 billion, previously having a net cash position. So the company is in a more financially risky position than it was before. Nuvei management forecasts fiscal 2023 adjusted EBITDA of $455 to $477 million. Using the midpoint of $466 million, the company has a net debt to adjusted EBITDA ratio of 2.3 times, which is quite high for this type of business. It's not absurdly high or anything, but it is something which you really do need to watch going forward. As well, the debt is floating, so if interest rates do continue to rise, the company will be impacted negatively, or possibly if they fall at this point. With all the bank stuff going on, we don't know, and I'm not really going to even comment on what direction it is because it is just a complete gamble at this point in time. Additionally, though, Nuvei did renew its normal course issuer bid, which could if used like they did in 2021, put more pressure on its balance sheet as they use up cash to buy back shares. Using the guidance midpoint EBITDA, we can find the enterprise to adjusted EBITDA value of 14.5 times, which is quite a high value because this is also a forward value, so you would normally want to see forward a bit lower. And this is still quite high either way, even if it was trailing. The trailing adjusted EBITDA is more reasonable at 22 times, but this does not account for the change in leverage. And that's what we've seen over the past month now is a massive change in leverage. So I would really rely on EV/EBITDA over PE in this case because they've seen this complete shift in leverage from being effectively a lower enterprise value compared to like a market value. And now we're seeing the enterprise value exceed the market value of the equity, that is. So concluding, Nuvei's operations are improving. They're less risky as they distance themselves from the volatility of cryptocurrencies. And they have also maintained high growth. And they're forecasting high growth as well. But it has significantly increased its financial leverage and risk from that. Combined with the high valuations of the metrics that I would rely on, which in this case would be EV/EBITDA over PE, it's just too expensive. They do have hopes in the long term if they're able to navigate through the risk of the short term, if they're able to pay off debt, if they're able to increase their revenue and then ultimately their cash flows to pay off that debt and leverage this acquisition of Paya, it could potentially have a bright future. So by no means am I completely writing off, but I would just hold off on it for now to see really how it works over the next year.
Yeah, I mean, I would agree. The calculus of the equation changes when you have that much leverage added to the balance sheet, again, at a variable rate and added to the business. If they somehow did that out of cash, this would be, a story to look significantly at. We've seen so many companies enter into either debt situations or issue shares. And, you get growth by acquisition, but is it profitable growth? And in this case, they're, like you said, they're going to have to service that debt. So and that is a significantly high level of debt for a business of this type.
At a floating rate.
If they continue to grow cash flow, and there is, they could service that debt, it's fine. But it is a high level right now at a time when you could be looking to in the payment sector, consumer slowdown. You could be looking into rates that are, higher now. They already are for them, but could they go higher? There's a possibility there. So, it's something that we continue to watch, but, where does the growth go from here too? What is the organic growth is what we'd have to look at in those businesses. And if there's significant organic growth, maybe it can make sense. But if it's, 5-2 or negative organic growth, that doesn't make sense because then suddenly it's getting a growth multiple at some point. Does it deserve a growth multiple if that or if the acquisitions are the only thing that are really leading to growth over time?
They are organically growing for the next year. At least that's what their forecast is. Mm-hmm. So they do have that. They're not inorganic growth driven at this point. It's just that debt is just really weighing me down. I think previous to the acquisition, we were a bit more hopeful, especially when they're now doing an NCIB renewal, which last year they did. I think it was like around 200 million in share buybacks. I'll put the exact number up on the screen. So if they're going to do that again instead of paying off debt, that just seems strange to me at this point.
At this point, I'd prefer them to pay down debt, right?
Mm-hmm. Yeah, exactly.
For sure.
And the renewal is just today, by the way. I should add that in. It's not like it was months ago.